Investors are buying both AI stocks and gold, two trends that tell very different stories. We'll cover that and more in today's quarterly investment perspective. How did stocks and bonds perform last quarter? Global markets advanced in the third quarter as moderating inflation, resilient economic growth, and central bank rate cuts lifted investor sentiment. In the U.S., stocks reached new highs after the Federal Reserve cut rates for the first time this year. Strong earnings from large cap tech and communication service companies continue to drive gains, while smaller cap stocks also moved higher as confidence improved. Most major sectors posted positive returns, with consumer staples in last place. Bonds also delivered solid results as interest rates moved lower. Treasuries, corporates, and municipal bonds all gained ground, supported by expectations for additional Fed easing and a stable credit environment. Overall, investors welcomed signs of steady growth and easing financial conditions, a combination that helped extend the year's broad market advance. What's next for markets? Looking ahead, stocks could continue to build on their gains as steady earnings, moderating inflation, and supportive monetary and tax policy create a favorable backdrop for investors. The Federal Reserve's rate cuts, along with easing by other central banks, should help sustain confidence and broaden participation beyond the largest tech companies. Lower borrowing costs and improving sentiment may continue to lift smaller and more cyclical areas of the market, while the adoption of AI across industries is expected to reinforce productivity and earnings growth more broadly. That said, returns are likely to moderate as investors weigh potentially slower global growth, still lingering tariff effects, and relatively high market valuations. Even so, solid corporate fundamentals and ongoing policy support point to a constructive outlook for both the economy and markets heading into 2026. How resilient is the U.S. economy right now? The U.S. economy held up well in the third quarter, with solid consumer spending and business investment offsetting a cooler labor market. Hiring slowed and unemployment ticked up, but layoffs remain limited, suggesting a gradual adjustment rather than a sharp downturn. Against this backdrop, the Federal Reserve lowered interest rates for the first time this year, shifting its focus towards sustaining growth as the labor market cooled. However, core inflation remained near 3%, held up by lingering tariff effects on certain goods and persistently higher service sector prices. Consensus expects the Fed funds rate to finish 2026 near 3%, implying 4 to 5 additional cuts, though sticky inflation suggests those expectations may be too aggressive. Abroad, growth steadied as fiscal measures and rate cuts supported activity across many regions. Overall, both the U.S. and global economies continue to demonstrate resilience amid ongoing policy shifts. Will economic growth hold up? Looking ahead, the U.S. economy is expected to maintain a moderate pace of growth into 2026. Lower interest rates and tax breaks should help keep consumer demand steady and improve business confidence, which together should help sustain activity even as hiring slows. The Federal Reserve's recent rate cut, the first since 2024, has restored confidence and additional easing is likely over the coming quarters. Inflation should continue to gradually decline, though lingering tariff effects and firm service sector demand may keep it above the Fed's long-term target for a while. Globally, major central banks are also easing policy and fiscal support remains in place. These factors, along with stable consumer trends and rising productivity, point to a steady, albeit slower, economic expansion in the year ahead. One of the most notable trends this year has been the simultaneous rise in both AI-related technology stocks and gold. At first glance, these seem like opposites, one signaling optimism about innovation and growth, and the other a search for safety and stability. Together, they illustrate how investors are responding to a market defined by both progress and uncertainty. The enthusiasm around artificial intelligence continues to drive investor attention and market performance. Many see AI as a lasting source of productivity gains and profit growth, potentially reshaping entire industries. That optimism has driven renewed investment in the largest technology companies and new AI-focused stock funds. further concentrating investor exposure in a segment that already represents a significant share of the market. At the same time, concern about rising deficits and geopolitical tensions has driven demand for perceived stores of value like gold. Adjusted for inflation, gold prices now sit at more than twice their long-term average levels that have often been followed by periods of weaker returns. Both trends reflect powerful forces shaping markets, but also reveal their vulnerabilities. In technology stocks, valuations already embed extraordinary expectations, leaving little room for slower adoption or earnings disappointment. In gold, sharp price swings and uneven performance during past market stress showed that its protection isn't always reliable when investors need it the most. This divergence between AI optimism and demand for gold reflects a market grappling with two realities: confidence in innovation and concern about the future path of policy and growth. Whether that tension eases or deepens will depend on how earnings, inflation, and central bank decisions unfold in the months ahead. For now, it underscores need for perspective as investors navigate an environment that remains both dynamic and uncertain. As mentioned earlier, with technology stocks continuing to climb, investors face a familiar challenge: how to participate in progress without becoming overexposed to it. The enthusiasm surrounding artificial intelligence has powered much of this year's market gains, but it's also concentrated performance within a small group of large companies. For many investors, portfolio results are now increasingly tied to these handful of dominant names. While innovation is an enduring driver of long-term growth, a narrow rally can make portfolios more vulnerable to shifts in sentiment or earning surprises. One way to address this concentration risk is by broadening exposure to innovation itself. That includes looking beyond the largest technology companies toward smaller, more specialized firms that are developing or applying AI in new ways. Opportunities are also emerging across other sectors. Industries like healthcare, industrials, and financials are adopting AI to improve efficiency and productivity, while infrastructure and energy companies are benefiting from the growing demand for data and power to support this technology. Expanding exposure across these areas, and furthermore into international and private markets, can help investors participate in the next wave of progress more broadly. At the same time, renewed interest in gold highlights investors' search for stability amid fiscal and geopolitical uncertainty. But unlike gold, essential real assets such as infrastructure and real estate have historically provided a more consistent and reliable form of stability within portfolios. These assets are tied to everyday economic activity, transportation networks, utilities, energy systems, and diverse property types that generate steady cash flow and tend to be far less volatile than gold or stocks. Both infrastructure and real estate also serve as effective inflation hedges, with rent payments, lease income, and asset values that often adjust alongside rising prices. Together, they can help smooth portfolio returns and preserve purchasing power over time. Bonds also continue to play a central role in diversified portfolios. Yields remain appealing by historical standards, and as interest rates move lower, bond prices could see additional appreciation. Together, income and potential price appreciation and low stock market correlation make high-quality bonds an important source of stability within balanced portfolios. With markets shifting between optimism and caution, portfolios built on broad, balanced diversification are generally well-positioned to adapt. Maintaining exposure across industries, regions, asset classes, and sources of return help investors participate in growth while managing risk along the way. As we enter the final months of the year, markets and the economy continue to adjust to a new phase of lower rates, solid growth, and rapid innovation. At Capstone, our focus remains on helping clients stay invested with confidence through thoughtful diversification, disciplined planning, and a clear long-term perspective. Thanks for joining us for this quarter's investment perspective.